And for more on the U.S. economy and that fourth quarter GDP number, we're joined by Michael Pento. He's the president and founder of Pento Portfolio Strategies. Michael, thank you for joining us. Good to have you on the show tonight.
Thanks so much for having me.
So, Michael, what is your interpretation of that 2.6% GDP number? It missed forecasts of 3%, and it comes after the economy's incredible 5% growth in the third quarter, 4.6% in the second quarter. Michael, what happened here?
Well, let's just talk about facts. Everybody was saying that 2014 would be the year that the economy achieved escape velocity. But if you look at the actual facts, in 2010, the economy grew by 2.5%. And after all these stimuli that we had from the Federal Reserve and government, we grew at 2.4% rate in 2014. There has been no escape velocity achieved whatsoever. And in 2010, when we had that anemic below trend growth rate of 2.5%, we had the Fed had our back. We had the Fed at our back. We had QE coming down the pike. Now we are faced interest rate increases coming down the road. So I'm not very ebullient at all.
So, Michael, you're saying that all the stimulus that we saw from the Fed in 2014, admittedly, they did wind down the program in October, but they've still kept interest rates at a low. You're saying that that really didn't work?
No, I mean, I'm not saying it. The data is saying that. Look at durable goods orders. They've been down 4 out of the last 5 months. Business spending on capital equipment dropped at a 1.9% annualized rate. The data is not very upbeat. And I'm very much concerned about the level of the stock market, most of all. You know, if you look at the stock market right now, we have a trailing 12-month PE ratio of 20, okay? If you look at the growth rate in earnings, it's going to be about 1%. So you have a PEG ratio of 20. This is a danger sign beyond, really an epic proportion for me. A big red flag. Watch out below on the stock market here.
Michael, certainly corporate earnings are causing some cause for concern. Many companies saying that they do expect forecasts to be lower for the year. But there are still signs that the economic recovery has gained some momentum. Let's look at job growth, for example. The U.S. had its best year of job growth since 1999 last year. Consumer confidence is the highest since 2004. Doesn't that point to some form of expansion in the economy, some bright spots?
Yeah, well, listen, not everything is bad. I don't want to come across and say everything is bad. Well, let's just take the job growth. So most of the job growth has been in the non-high wage sector. If you look at what's happening with Obamacare, you have a waitress that was working at a restaurant making, minimum wage and working 40 hours a week. And now because of Obamacare, perhaps they kept her on at 20 hours a week and hired another person for 20 hours a week. So you're getting an increase in employment. But the real surge in earnings, you look at the aggregate hours worked and hours earned, the earnings, they're just not there.
Michael, can't argue with that. Wages aren't growing. And yes, many would say that Obamacare is deterring employers from hiring more full-time workers. Let's look at some other factors at play as we go forward. The plunge in oil prices. What do you see the impact of that being over the next 2 quarters? On the one hand, U.S. consumers could get a reprieve from lower gas prices. On the other hand, many are saying it's not good news because oil companies are going to be sustaining lots of losses, and that could come with layoffs that could spill over into other parts of the economy. What's your take, Michael?
Well, it's the end of the U.S. Listen, it's the end of the U.S. fracking industry. You know, these companies are not profitable at $47. And if oil was the only thing going down in price, I would be much more upbeat. But copper prices are in the hole. Base metals are contracting. Bond yields are plunging across the planet. Japan is in a recession. Europe is in stagnation. China's growth rate is falling. I'm looking out and I am seeing deflation across the planet. And if you're just concentrating on lower oil prices, I will submit to you lower oil prices that were going from $147 a barrel in 2008 to $33 a barrel in March of 2009. It wasn't a sign of a healthy economy. It was a sign that the bubble created by global central banks
Right, Michael, we're having some issues with our connection. Unfortunately, we're going to have to leave it there. But thank you so much to Michael Pento,